Most investors believe bubbles are obvious. They look at past charts and say, that was irrational. That was clearly unsustainable. How did people not see it? But when you are inside a bubble, it never feels irrational. It feels validated. It feels confirmed. It feels socially reinforced. Because bubbles are not primarily financial events, they are social events. Humans are not independent decision makers. We are social learners. Robert Cialdini's research on social proof demonstrates that when individuals are uncertain, they look to others for cues about correct behavior. Uncertainty increases imitation. Financial markets are environments of constant uncertainty, which makes them ideal environments for social contagion. When prices rise consistently, something subtle happens. Rising prices create visible success. Visible success creates attention. Attention creates imitation. Imitation creates momentum. Momentum validates the original behavior. This feedback loop can continue far longer than rational models predict. Let's examine historical bubbles. The Dutch tulip mania in the 1600s. The South Sea bubble in 1720. The railroad boom of the 1800s. The dot-com bubble of the late 1990s. The housing bubble of the mid-2000s. The crypto bubble of 2017, and again in 2021. In each case, participants did not believe they were irrational. They believed they were participating in transformation, technological change, financial innovation, structural shifts, and often they were partially correct. Bubbles are dangerous precisely because the underlying narrative often contains truth. But truth combined with crowd reinforcement creates amplification. Solomon Asch's conformity experiments in the 1950s demonstrated something powerful. Participants were asked simple, visual comparison questions. When Confederates intentionally gave wrong answers, a large percentage of participants conformed, even when the correct answer was obvious. Why? Because social alignment reduces discomfort, and being wrong alone feels worse than being wrong collectively. In markets, this effect is magnified because price action provides visible evidence that the group is right. If everyone is buying and prices are rising, dissent feels costly, not just financially, socially. Herding behavior in markets is well documented. Studies in behavioral finance show that professional fund managers often cluster into similar trades, not necessarily because they believe the trade is optimal, but because career risk discourages deviation. John Maynard Keynes once said, "It is better for reputation to fail conventionally than to succeed unconventionally." This is career herding. If you lose money alone, you look incompetent. If you lose money with everyone else, you look unlucky. That asymmetry influences decision-making at institutional levels. Social proof also distorts perceived risk. When more participants join a trend, perceived safety increases, even if objective risk increases. This is because humans equate popularity with validity. In psychology, this is called informational social influence. When uncertain, people assume others possess superior information. But in markets, others may simply be following the same logic or following each other. This creates recursive imitation, a loop of reinforcement without independent evaluation. Let's analyze the dot-com bubble. During the late 1990s, internet adoption was real. Technology transformation was real, but valuations detached from earnings reality. Companies with no revenue reached billion-dollar valuations. Why did rational investors participate? Because staying out meant underperformance. Underperformance meant client withdrawals. Client withdrawals meant career risk. Social pressure amplified exposure. Participation became safer than skepticism. Until it wasn't. The same structure appeared in the housing bubble. Home prices had risen for years. Financial institutions created increasingly complex derivatives. Credit standards loosened. Risk was distributed, but not reduced. Rating agencies reinforced confidence. Banks reinforced leverage. Consumers reinforced optimism. Each layer validated the next. The system felt stable because everyone was participating. That is the essence of social proof. The presence of others reduces perceived danger. Social proof is especially powerful during early bull markets. Initial gains attract early adopters. Early adopters report success. Media amplifies stories. Success stories increase participation. Participation increases price. price validates narrative, and the cycle accelerates. The more people join, the harder it becomes to dissent. Because dissent requires tolerating both financial and social isolation. There's also the effect of narrative alignment. When a bubble forms, a dominant story emerges. This changes everything. This time is different. The old metrics no longer apply. These phrases reduce cognitive friction. They justify valuation expansion. They silence skepticism. Robert Shiller's work on narrative economics shows that economic narratives spread like viruses. They replicate, they mutate, they persist. Markets are driven not only by cash flows, but by contagious stories. Now let's discuss the personal dimension. When your peers are making money rapidly, emotional pressure increases. Envy, fear of missing out, perceived inadequacy. These emotions distort risk assessment. The decision becomes less about expected value and more about relative positioning. Everyone else is in. Why am I not? That is not analysis. That is social comparison. And social comparison amplifies volatility in behavior. There's also an asymmetry in feedback. If you join a bubble early and profit, you feel validated. If you stay out and prices continue rising, you feel wrong. Even if you are structurally correct long term, this psychological asymmetry pushes participation because short-term underperformance feels like incompetence, even when it is prudence. How do bubbles end? Not when narratives disappear, not when valuation models fail, but when liquidity tightens, when marginal buyers disappear, when leverage contracts, and when the social proof reverses. Falling prices create visible losses. Visible losses create fear. Fear creates withdrawal. Withdrawal accelerates decline. The same social dynamics that inflated the bubble now collapse it. So how do you defend against social proof? First, measure valuation independently of popularity. Second, track exposure relative to crowd positioning. If everyone agrees, risk is rarely low. Third, separate narrative quality from price momentum. A good story does not justify infinite valuation. Fourth, diversify information sources. Algorithm-driven feeds amplify confirmation bias. Seek dissent intentionally. Fifth, define participation limits in advance. Before entering high momentum environments, define size and exit conditions, not after volatility appears. The goal is not to avoid every bubble. Participation in early stages can be rational. The goal is to avoid identity fusion with the crowd. When your confidence depends on collective agreement, flexibility disappears. And inflexibility in dynamic systems creates fragility. If you remember three things from this video. First, bubbles are social phenomena before they are financial ones. Second, social proof reduces perceived risk while increasing actual risk. Third, dissent requires emotional tolerance, not just analytical skill. Markets do not become irrational suddenly. They become socially synchronized. And synchronized systems are powerful until they break